Good morning, girls. I am DR.V.RENUGA, Associate Professor of Commerce, A.D.M.COLLEGE for Women, NAGAPATTIam. Today, we are going to see some of the concepts and definition which are used in income tax law and practice. Basic concept, components of income tax law. We are having Income Tax Act 1961, then Annual Finance Act, and Income Tax Rule, circulars and notification, and the legal decision which are taken by the government. Steps for computation of the total income of an assessee and levying of tax liability. First, we have to determine the residential status of the assessee, and we have to classify the income under different heads. After that, we have to compute the total income of an assessee and clubbing of income and set off and carry forward of losses and computation of gross total income under different heads and deductions allowed from the gross total income and computation of total income, and finally we have to compute the tax liability of an assessee. Important definitions which are used in the Act: assessee, assessment, person, income, then assessment year, previous year, and minimum marginal rate or average tax rate. And basis of charge of income tax, income under different heads. And what is tax? Before that, we have to consider we are living in a society, and in that society we are live with all facilities, that is infrastructure facilities or basic facilities which are required by us. That facilities are provided by the government only from the revenue collected from us. That revenue is considered to be the tax. So taxes are considered to be the cost of living in a society, and the tax is levied by the government to meet out the common welfare expenditure of the society. The common welfare expenditure means that is we need certain infrastructure facilities like electricity, water, road facilities and housing. That facilities are provided by the government from the revenue collected from us. Type of taxes. Taxes are classified into two broad categories. One is direct tax, another one is indirect tax. In direct tax, we are having income tax and tax on undisclosed foreign income and assets. Indirect taxes, we are having GST, that is goods and services tax, and customs duty. First, we have to know the terms or the definitions of certain concepts which are used in the income tax frequently. First one, assessment. Assessment means the process of examining the return of income by the income tax department is called as assessment. The assessment is a procedure by which the income of an assessee is determined by the assessing officer, and that assessment may be normal assessment or sometimes it may be reassessment of income already assessed by the income tax department. Assessment year. Assessment year means the period of 12 months beginning from 1st April every year and ending on 31st March of the immediately following year. For example, the current assessment year is 21-22. It commences on 1st April 21 and will end on 31st March 2022. Financial year or the previous year. Income earned in a year is taxable in the next year. The year in which the income is earned is called or known as previous year. Previous year means we can also call it as the financial year of the government. Difference between the financial year and the assessment year. It is a year in which you have earned the total income. That is the financial year. For example, the financial year is 2021. It means the income earned from 1st April 2020 to 31st March 2021. Assessment year. The income earned in financial year becomes taxable in the assessment year. For example, income of financial year 2021 will become taxable in assessment year 2021-22. The due date of filing of return is 31st July of the assessment year, that is 31st July 2022. Income. Income is the revenue a business earns from selling its goods and services or the money an individual receives in compensation for his or her labor, services or investment. Income includes under section 2 of 24 of the Income Tax Act 1961 certain terms: profits and gains, dividend, voluntary contribution received by a trust wholly or partially for charitable or religious purposes, perquisite, special allowance or benefit, any allowances, value of any benefit or perquisite granted to director of a company, value of any benefit or perquisite received any representative assessee, any sum chargeable to Income Tax Act, any capital gain under section 45, any profits and gains of any business, any winnings, any sum received under keyman insurance, contributions received by a trust, amount received by way of gift exceeding rupees 50,000, any advance money received and forfeited during negotiation to sell a capital asset. Person. Normally, we can say a person means a human being. But under the Income Tax Act, person means we have two certain terms. The terms are an individual, a Hindu undivided family, a company, a firm, an association of person, that is AOP, a local authority, BOI or body of individual, and artificial juridical person. According to section 2 of 31 of the Income Tax Act 1961, the term person includes an individual, a natural person or a human being is an individual. An individual may be male, female or a lunatic. Now we can also consider the transgender. A Hindu undivided family, HUF. A family consists of all the members of the lineally descended from a common ancestor, including their wives and unmarried daughters. A company, an artificial person created by law with perpetual succession, a common seal and common stock divided into shares with limited liability. A firm, a partnership firm which is defined by the Partnership Act. An association of person, we can also call it as AOP, if two or more persons associate themselves for managing a property for the purpose of producing or earning income. Body of individuals, BOI, it means a conglomeration of individuals who carry on some activity with the objective of earning some income. It would consist of individuals alone. A local authority, that means municipality, district board, panchayat, port trust, etc. Artificial juridical person inclusive of Life Insurance Corporation of India, education institution like a university. Assessee. Now we have to know or consider the meaning of the term assessee. An assessee means a person who is liable to pay taxes to the government against any kind of income earned or any losses incurred by him for a particular assessment year. Each and every person who has been taxed in the previous year for income earned by him is treated as an assessee under the Income Tax Act 1961. Representative assessee or deemed assessee. A person who is liable not only for his income or loss but also for the income or loss of other persons in case of deceased person, in case of lunatic or minor or idiot, in case of non-residents. Assessee in default. Who is considered to be an assessee in default? An assessee in default is an individual who has failed to fulfill his legal duty of paying tax to the government. Gross total income. Gross total income means it is a income that is you have earned by adding all heads of income. The heads of incomes are income from salary, income from house property, income from business or profession, income from capital gain, and income from other sources in a financial year are all added to arrive at the gross total income or GTI. all income under the 5 heads: income from salary, income from house property, business or profession, capital gain and other sources, before deducting the deductions specified under section 80C to 80U of the Income Tax Act 1961 is the definition of the gross total income. Now we can see the definition of total income. Total income means all sum of money received by an individual or an organization, including income from employment or providing services, revenue from sales, payments from pension plans, income from dividend or other sources. All income chargeable under the 5 heads: income from salary, house property, business or profession, capital gain and other sources, after deducting the deductions specified under section 80C to 80U of the Income Tax Act. Casual income. Casual income means any income received by an assessee occasionally. Casual income is a non-recurring income that is not likely to occur again in a year. It is an income which is earned by chance. Such income is neither anticipated nor provided for in any agreement. Such incomes are received at uncertain times. Now we can see the residential status of an individual. We can classify the residential status of an individual broadly into 2 categories: resident and non-resident. Again, the resident is classified into 2: ordinary resident and not ordinarily resident. Taxable entities. Who are all considered as taxable entities? Taxable entities are classified into following categories: individual, HUF, that means Hindu undivided family, a firm or an AOP, a joint stock company and every other person. Classification of residential status of taxable entities. First, we can see the residential status of an individual and the Hindu undivided family. An individual or a Hindu undivided family can have the resident and ordinary resident in India, resident but not ordinarily resident in India, and non-resident in India. The individuals and HUF are having the 3 categories of the residential status, that is resident, not ordinary resident and non-resident, and other persons defined under the term person are having only 2 categories of residential status, that is resident and non-resident. That is all other assessees: a firm, AOP, a joint stock company and every other person resident in India or non-resident in India. The residential status of an individual. How we can assess the residential status of an individual under section 6 of 1. An individual is said to be a resident in India if he satisfies any one of the 2 basic conditions. The basic conditions are: first one is an individual is in India during the relevant previous year for a period amounting in all to 182 days or more. Second one, an individual is in India for a period or periods amounting in all to 365 days or more during the 4 years preceding the relevant previous year, and he is in India for a period of 60 days or more during the previous year. For example, if the previous year is 2020 and 21, that is 20 to 21, an assessee, that is an individual who is in India for a period not exceeding 182 days. Additional conditions. He has been, that is an individual has been resident in India at least 2 out of the 10 previous year preceding the relevant previous year, that is the individual must have satisfied at least one of the basic conditions of 2 out of 10 years preceding the previous year. Second additional condition, he has been in India for at least 730 days in all during the 7 previous year preceding the relevant previous year. Resident but not ordinarily resident. Section 6 of the IT Act. If an individual satisfies any one of the basic conditions and one or none of the two additional conditions he is considered to be not ordinarily resident. It is for the assessee to prove that he is a resident but not ordinarily resident because the incidence of tax is usually lies on this category than on ordinarily resident. Finally, we can consider the residential status of an individual and HEF by considering the basic conditions and additional condition. In simple words, if an individual satisfies any one of the basic condition, that means he is staying in India for a period of 182 days in the relevant previous year or 365 days in the preceding 4 years and 60 days in the relevant previous year and satisfying the two additional conditions, that is 2 out of 10 years preceding the relevant previous year and 730 days in the preceding 7 years, an individual is said to be resident of India. Suppose if a person, that is an individual, is not satisfying the basic conditions and satisfy the additional condition, he is said to be non-resident of India. Suppose an individual satisfy any one of the basic condition, that is 182 days in the relevant previous year or 365 days in the preceding 4 years and 60 days in the relevant previous year, but not satisfying the additional conditions of 2 out of 10 years or 730 days in the preceding 7 years, that individual is said to be not ordinarily resident in the relevant previous year. Thank you, girls.